Let's explore RSI. In this lesson, we'll take a closer look at the Relative Strength Index, RSI. You'll learn what RSI is, how it's calculated, and how to interpret its values on a 0-100 scale. By the end, you'll understand how RSI can help you gauge market strength and spot potential turning points. RSI doesn't measure volume. It measures price momentum by comparing average gains and losses over a specific number of periods. Now that you know RSI measures price momentum, let's look at how it's actually calculated. You won't need to do the math manually, but knowing the formula helps you trust what RSI tells you. The RSI compares average gains and losses over a set period to measure momentum. If gains are stronger, RSI rises. If losses outweigh gains, RSI falls. The result is a number from 0 to 100 that shows whether the market is strong, closer to 100, or weak, closer to 0. RSI levels give helpful signals but only when read in context. A reading below 30 might suggest an oversold condition, but in strong downtrends, RSI can stay low. Likewise, in powerful uptrends, RSI may remain above 70 for extended periods. This is where momentum and market pressure come into play. When bullish momentum dominates, RSI can hover high without a reversal. When bearish pressure increases, RSI may stay low longer than expected. Before reacting, ask, is this lasting pressure or just a short-term move? This is where momentum and market pressure come into play. When bullish momentum dominates, RSI can hover high without a reversal. When bearish pressure increases, RSI may stay low longer than expected. Before reacting, ask, is this lasting pressure or just a short-term move? Explanation. That's right. When RSI falls to or below 30, it often signals that the stock is oversold. This could mean a reversal is near, making it a potential buying opportunity, though confirmation with other tools is always a good idea. You've learned how RSI is calculated and what its values mean. Next, we'll explore how RSI behaves in different market conditions and how that changes the way traders interpret signals. Spotting overbought and oversold conditions. It's time to explore two of its most useful features, identifying overbought and oversold conditions. In this lesson, You'll learn how to recognize when the market might be stretched too far in one direction and how traders use this to prepare for possible reversals or pullbacks. As you already know, RSI highlights overbought and oversold zones. But how do these levels actually work in different market conditions? When RSI moves above 70, the asset is considered overbought, meaning it's experienced strong recent gains and may be due for a pullback. But overbought doesn't always mean sell right away. In strong uptrends, RSI can stay high for a while. When RSI drops below 30, the asset is considered oversold, meaning it's seen significant losses and might bounce soon. Just like with overbought conditions, a low RSI isn't an automatic buy signal. It depends on the broader trend. Overbought and oversold zones work best in range-bound markets. In trends, RSI can stay extreme for a long time. For example, in an uptrend, RSI may stay above 70. Selling too early means missing gains. Always check the market context before using RSI signals. In highly volatile markets, price moves fast, and RSI can whipsaw between extremes. These shifts often happen too quickly to act on and can lead to false signals. In such an environment, use support resistance or trend filters to confirm trades. Additionally, when momentum is strong, like during a breakout, RSI can stay in overbought or oversold territory much longer than expected. This doesn't mean reversal, it shows momentum. Nice job. There's one more factor that affects how RSI behaves: the setting you use. Those oversold and overbought zones can shift depending on your RSI setting. A shorter setting gives quicker signals, while a longer setting reacts more slowly. How should you choose your RSI setting? It depends on your trading style. If you prefer short-term trading or scalping, you should use settings like 5 or 7, where 90 might signal overbought and 10 oversold. It is great for speed, but creates more noise. Swing traders often use the default 14-period setting with the classic 70/30 zones, which helps balance reactivity and stability. Longer-term traders might use 21 or more, focusing on broader moves, where 60/40 might be more relevant. Remember that your RSI setting changes what the signal means. Shorter settings equals quicker signals but more false alarms. Longer settings equals slower but more reliable confirmation. You now understand how RSI behaves in trending and volatile markets, and how to choose the right settings for your style. Next, we'll explore divergence, a powerful tool to help you stay ahead of trend changes. Spot reversals with RSI divergence. In this lesson, we're digging deeper into RSI by focusing on divergence, a key concept that helps traders predict potential reversals before they happen. You'll learn the difference between regular and hidden divergence and how to use each one in real trading scenarios. Remember, RSI works best as a confirmation tool, not a standalone signal. One powerful confirmation method is spotting divergence. When RSI and price move in opposite directions, this can be an early warning sign that the current trend may be about to reverse. Not all divergence is the same. You can see the bullish divergence when the price goes down, making lower lows, but RSI goes up, making higher lows. This suggests the downtrend may be weakening, and a price rise could be coming. Even though bullish divergence hints at a possible reversal, it's not a guaranteed signal to buy right away. Smart traders wait for confirmation, like a breakout, a bullish candle pattern, or RSI crossing above 30, before entering a trade. Confirmation helps reduce the risk of false signals. On the other hand, the bearish divergence can be detected when the price goes up, making higher highs, but RSI goes down, making lower highs. This may signal that the uptrend is losing strength, and a price drop could follow. You spotted bearish divergence. You see the price making higher highs, but RSI is making lower highs. Quiz: what does this typically suggest? Explanation: that's right. Bearish divergence often suggests a weakening uptrend. It's not a guaranteed reversal, but a sign to watch for confirmation and prepare for a potential sell. Remember that regular divergence happens when price and RSI move in opposite directions at key extremes and often signals a possible trend reversal. Let's practice using RSI divergence. Take a look at this EUR/GBP 4-hour chart. Price is making higher highs, but RSI is making lower highs. This is a classic RSI divergence setup. Quiz: you spot this divergence after the third push higher. What action would you consider? Explanation: good choice. While RSI divergence signals that the uptrend might be losing momentum, it doesn't guarantee a reversal. Waiting for price confirmation, like a bearish candle pattern or a break below support, helps you avoid false signals and improves trade timing. Although spotting divergence is powerful, it's best not to rely on it alone. Always confirm with price action or other tools. For example, wait for a lower high in price, a break of a support level, or a bearish candlestick pattern before taking action. While regular divergence signals potential trend reversals, hidden divergence indicates trend continuation. It's called hidden because it's subtler and often overlooked. A bullish hidden divergence occurs when price forms higher lows, but RSI forms lower lows. It suggests that the uptrend will continue. Bearish hidden divergence occurs when price forms lower highs, but RSI forms higher highs. It indicates the downtrend may persist. Regular or hidden divergence. You're analyzing a stock in an uptrend. After a dip, the price forms a higher low, but RSI shows a lower low, signaling weaker momentum. Quiz: what kind of divergence does this show, and what could happen next? Explanation: almost. Remember, regular divergence signals reversal, while hidden divergence supports the current trend. Price made a higher low, still in an uptrend, so this isn't bearish. It's a sign the uptrend might resume soon. You've explored how RSI divergence reveals potential turning points and how hidden divergence can tip you off to trend continuation. Now, let's test what you've learned with a quick quiz.